Thank you, Mr. Chairman. Appreciate you holding this hearing today, and thank you to our witnesses for appearing before the committee. I look forward to your testimony. The allocation of credit is the lifeblood of the American economy. Lenders, insurers, and other financial firms rely on accurate credit reports to reflect the potential risk of a customer, and consumers expect that their credit reports are fair and appropriately reflect their financial histories to ensure they may access financial products at competitive prices. Mechanisms exist for consumers to file a complaint or to dispute an inaccuracy in their credit report. The Fair Credit Reporting Act directs the CFPB to submit an annual report about complaints to Congress. In the most recent report, the CFPB stated that prior to COVID-19, the average number of complaints were approximately 300,000 per year, but in 2020, there were approximately 542,300 complaints, a 54% increase from 2019. I look forward to learning more today from our witnesses about the potential causes for an increase in complaints and what the credit reporting agencies are doing to address them. In March of last year, Congress acted to ensure that consumer credit histories were not adversely impacted as a direct result of the COVID-19 pandemic and ensuing economic challenges. As part of the CARES Act, Congress amended the Fair Credit Reporting Act to ensure that consumers were protected during the pandemic, clarifying that accommodations made by lenders or other creditors for customers were not included as negative entries on their credit reports. The credit bureaus themselves made additional accommodations to serve customers during the pandemic, and I look forward to hearing more about their activities during today's hearing. Despite many advancements and innovations in financial services, a staggering number of Americans remain unable to access credit. A recent study by the Federal Reserve Bank of New York found that at the end of 2018, approximately 26.5 million adult Americans, or roughly 10.5% of the population, were not in the formal credit economy and thus did not have a credit history. This so-called credit invisibility disproportionately impacts consumers in rural areas and can perpetuate the cycle of reduced access to traditional financial services. While many consumers may not have traditional credit histories, they should be able to leverage alternative examples of their financial health. On-time payment of cell phone bills, rent, utility bills, and other payments, and other alternative data are indicative of a consumer's ability to repay. I hope to learn more about how the credit bureaus are innovating to account for this alternative data and the outlook for expanding credit availability to underserved or credit invisible individuals. Unfortunately, some on the other side, including the president, are using imperfections in the current credit reporting landscape to push for radical solutions that would increase prices for consumers, limit competition, and make credit less available, especially for low and moderate income borrowers. The Biden administration has proposed eliminating the private sector credit bureaus and replacing them with a centralized, nationalized credit reporting bureau run by the CFPB. While the current credit reporting system is not perfect, nationalizing the process and thus eliminating all incentives for sound customer service and innovation will leave consumers further behind. Appropriate government oversight of the credit reporting agencies and private sector innovation are the most effective means to reduce credit data errors and bring about a more inclusive credit system. We've also heard a growing chorus of my colleagues on the other side calling to eliminate risk-based pricing in financial services. But risk-based pricing in credit allocation, insurance, and other financial products is essential to ensuring that consumers are paying the appropriate price for their products. Firms are adequately managing risk, and allocation of credit is not arbitrarily limited based on onerous, one-size-fits-all restrictions. Firms are prohibited from pricing risk based on race, nationality, religion, or other demographic characteristics, instead focusing on the metrics that demonstrably reflect and accurately reflect a consumer's ability to repay. A recent study from the U.S. Chamber of Commerce illustrates that eliminating risk-based pricing and replacing it with a uniform pricing model would raise prices on consumers and limit availability of credit and other financial services to low and middle income borrowers. A prohibition on using predictive data would not make the system more equitable, but instead dramatically exacerbate the inequalities we all hope to eliminate. I look forward to discussing these important topics today. And Mr. Chairman, on a personal note, this will be my last hearing as ranking member of the Oversight Subcommittee as I move on next month to serve as the ranking member of the National Security and Monetary Policy Subcommittee. It has been a pleasure serving on this subcommittee with you. Thank you, and I yield back.